In 2008, 8.7 million Americans lost their jobs, not over years, over months. In 2020, the entire global economy shrank faster than at any point in recorded history in a matter of weeks. And right now, economists, central banks, and governments around the world are watching the same warning signs that came before both of those moments. So if you don't fully understand what a recession is, what causes it, what it does to real people, and what can actually stop it, this is the video you need to watch. Let's start with the basics. An economy is always either growing or shrinking. When it's growing, businesses are producing more, people are earning more, and life generally feels pretty good. But when it starts shrinking, that's when things get uncomfortable. The traditional definition of a recession is 2 consecutive quarters of negative GDP growth. GDP stands for Gross Domestic Product, essentially the total value of everything an economy produces: goods, services, everything. When that number shrinks for 6 months in a row, economists officially call it a recession. But here's where it gets interesting. In the United States, the official call is actually made by a group called the NBER, the National Bureau of Economic Research. And they don't just look at GDP. They look at employment levels, personal income, consumer spending, and industrial production. It's a much fuller picture. So while the 2-quarter rule is a useful shorthand, the reality is a little more nuanced. A recession is really any significant, widespread, and sustained decline in economic activity. Simple enough, but the causes? Those are where things get really fascinating. Recessions are almost never caused by just one thing. They're usually the result of multiple forces colliding at once. But there are a few common culprits that keep showing up throughout history. The first is high inflation. When prices rise too fast, central banks step in and raise interest rates to cool things down. Higher rates make borrowing more expensive for businesses, for home buyers, for everyone. People spend less, companies invest less. The economy slows. The second is financial crises. Think about 2008. Banks were sitting on mountains of risky mortgage debt. When the housing market collapsed, it triggered a chain reaction. Banks stopped lending, credit froze, and the entire global economy seized up almost overnight. The third is external shocks. Sometimes recessions come from completely outside the economy. A pandemic, a war, an oil embargo, events that disrupt supply chains, crush consumer confidence, or physically stop people from working. And the fourth, and maybe the most underrated, is a loss of confidence. Economies run on trust. When businesses and consumers start believing that bad times are coming, they pull back spending and investment. And that pullback itself can cause the very recession they feared. It becomes a self-fulfilling prophecy. Okay, so a recession has started. What actually changes? The first and most visible sign is rising unemployment. When demand for goods and services falls, businesses need to cut costs, and the fastest way to do that is reducing their workforce. Job losses pile up, and as more people lose income, they spend less, which reduces demand further. It's a negative feedback loop. Credit tightens. Banks, worried about defaults, become much more cautious about who they lend to. Getting a mortgage, a business loan, or even a credit card becomes harder. This squeezes both consumers and businesses at exactly the moment they need support. Asset prices fall. Stock markets typically decline during recessions as corporate earnings drop and investors get nervous. Property prices can fall too, which is particularly painful for homeowners who borrowed heavily. And perhaps most importantly, confidence collapses. People and businesses become cautious, uncertain, and defensive. Investment dries up. Big purchases get postponed. Everyone is waiting for things to stabilize before they act. Governments and central banks have 2 main weapons against recessions. The first is fiscal policy, and the second is monetary policy. Fiscal policy is what governments do, directly spending more money or cutting taxes to inject cash into the economy. Think stimulus checks sent directly to citizens, or large infrastructure projects that create jobs. The idea is simple. If the private sector is pulling back, the government steps in as the spender of last resort. Monetary policy is what central banks do primarily by adjusting interest rates. When a recession hits, central banks typically cut rates dramatically to make borrowing cheaper, encouraging businesses to invest and consumers to spend. In severe downturns, they can even go further, buying financial assets in a process called quantitative easing to pump money directly into the financial system. In most serious recessions, you'll see both tools deployed simultaneously. The 2008 financial crisis saw governments around the world launching trillion-dollar stimulus packages while central banks cut rates to near zero. Let's look at three recessions that shaped the modern world. The Great Depression, 1929 to 1939, is the benchmark against which all others are measured. Triggered by the stock market crash of 1929, it spiraled into a decade-long catastrophe. U.S. unemployment hit 25%. Thousands of banks collapsed. International trade fell by more than half. It fundamentally changed how governments thought about economic management. The 2008 global financial crisis was the worst since the Great Depression. Born from the collapse of the U.S. housing bubble and reckless financial products called mortgage-backed securities, it spread across the globe within months. Governments deployed unprecedented fiscal and monetary stimulus to prevent another depression and narrowly succeeded. Then there's the COVID recession of 2020, the strangest recession in history. It was the sharpest contraction ever recorded in peacetime, but also the shortest. The U.S. officially entered and exited recession within 2 months. Massive government intervention, including direct payments to citizens and near-zero interest rates, cushioned the blow in a way that was impossible in 1929. A recession is not just an abstract economic term, it's a real, tangible force that affects jobs, savings, businesses, and everyday life. It's caused by a mix of financial stress, policy mistakes, and lost confidence. Governments fight back using both spending and interest rates. And while every recession is painful, history shows that economies recover. If you want to go deeper on any of this, how interest rates actually work, or the full story behind 2008, drop it in the comments. Those are videos I can absolutely make. If this helped you understand something you've been hearing about in the news, hit like, subscribe if you haven't already, and share it with someone who'd find it useful. Knowledge is the best hedge against uncertainty. I'll see you in the next one.